Welcome to the Credit Clubhouse podcast, a deep dive into the world of credit markets and alternative finance. Before jumping into our next episode, we have an exclusive offer for our listeners. Just head to dealcatalyst.io, pick any event, and then enter the promo code CREDIT at checkout. This will provide you 10% off any ticket to any conference. This offer is limited to the first 50 ticket buyers. Don't forget, we want you to follow the show, rate us, and leave a review. We encourage your feedback, and we want to hear from you, the listener. The next episode is presented by 9fin. Every day, you're making decisions that matter. Which credit to buy, which deal to pitch, which covenant terms will hold. You need the right intelligence, you need it fast, and you need to trust it. That's where 9fin comes in. One AI-powered platform with complete visibility across public, private, and distressed credit, built for how credit teams actually work. Head to www.9fin.com/demo to request a 30-minute personalized demonstration. Again, that is www.9fin.com/demo. And now, on to our next episode. Welcome back to the latest installment of the Credit Clubhouse. As always, I'm your host, Todd Anderson, Head of Content and Programming at Deal Catalyst. Joining me today is Adrian Cachinero, one of the co-founders of Steakhouse Financial. Adrian, I really appreciate your time, so thanks for joining me. Pleasure to meet you virtually.
Yeah, pleasure to meet you too, and thanks for having me. Hopefully, you'll get one of the most boring perspectives on credit in crypto that you could get from our industry.
Well, I've been in and around either credit or innovation around financial services. I ran a fintech conference for a long time before moving over to Deal Catalyst, and so I've been kind of always fascinated by the potential of crypto and DeFi. And so I think for the sake of our audience here, who might not be as schooled in it but might be hearing about it, especially today, a bit more. What is the difference between crypto versus DeFi? Are they the same thing? Maybe just a little bit of a level set of what they are and kind of maybe where we are today.
Yeah, for sure. I think it's a good place to start, because if I judge by, for example, the average Financial Times comments thread on any article about stablecoins or crypto, there's a lot of education that the DeFi space needs to do to reach out to these people and persuade them that it's actually, like, it's not that exciting. It is actually quite boring. And crypto and DeFi are, so you can have crypto without DeFi. You can't really have DeFi without crypto. And sort of before we get into it, maybe let's sort of try and explore the space with an open mind, because there's so much noise about the industry and it feels like everybody already has an opinion. But if you're a finance nerd, like I am, like we are at Steakhouse, you'll find, I think, that there's a lot of meat on the bone, and crypto has a way of nerd sniping like real finance geeks really effectively, because it has a way of simplifying finance down to its core components. And so to like what the difference is between crypto and DeFi, the way that I think about crypto is a sort of catch-all term for digital assets that have some credibility as a capital asset, a consumable, transformable asset, and a store of value asset in like this traditional, like textbook, finance classification. And it's quite unique in this regard because it's maybe one of the only assets that shares features of all three. The two or three biggest and, let's say, major crypto assets, I would categorize them as sort of Bitcoin, Ethereum, and Solana, with a long tail of more emergent assets. And what these networks do is guarantee their properties cryptographically. So they offer a network that people can use, and they can make those guarantees mathematically and cryptographically strong. And once you have a sufficiently strong network, and assuming that the network features allow for programmability, you can actually make applications that run on top of these networks. And that's where DeFi sort of comes in. And, compared to, let's say, traditional finance settlement, where if you think of settlement down the credit risk of like central bank money to bank deposits to like securities or whatever, the settlement tends to stretch out into the days. And with crypto, you get settlement finality. So a block will clear on Ethereum once every 12 seconds, but a block will be final around roughly 15 minutes. And there's a whole community of people working on getting it down to a sub-second. So this is a very, very strong settlement guarantee. And it's a very useful property to build applications on top of. And so DeFi, and so this is as opposed to DeFi. So where crypto for us is sort of the settlement layer, DeFi is a category of applications that you can build on top of that settlement layer. And for us, it's mostly on-chain asset-backed finance, really, DeFi. Simplistically, DeFi are programs that kind of resemble spreadsheets in the sense that they compute ledgers of who owes what to when and how, and how different balances accrue. You can certainly do a lot on crypto, but finance is by far the biggest application. And this ranges from tokenizing dollars and allowing them to transfer seamlessly, and what we know as stablecoins, to doing things like building repo markets, and even more complex things like perpetual futures and so forth. And the funny effect of crypto is that I use the terms interchangeably, but for the sake of the podcast, the funny thing about DeFi is that we've sort of run the history book of all of financial history from the beginning, like working out what works, what doesn't work, scams, Ponzi's, financial primitives. And, yes, it's absolutely reinventing the history book, but from a different perspective, if you had to invent finance from scratch completely today in a digitally native context, it would probably look a lot like DeFi, actually. So it obviously makes adoption longer and more complicated because, we had a wave of financial innovation with fintechs where a lot of the pain points were around how do these new application interfaces on front ends and experiences plug into legacy systems? And the approach with DeFi is just like, forget all of that. Let's just make it, let's just ignore it completely and just build a new foundation layer and try and rebuild it from there. So it has obviously taken a lot longer. But that's sort of the approach that's sort of the bet that we make with DeFi, that eventually when enough people use it, it will start to accrue value through network effects, and it will eventually become, we will eventually not make the distinction between DeFi and traditional finance, or TradFi in the jargon.
So when I was doing some research for this episode, you state on your website, the world is becoming a stablecoin economy and we are building a stablecoin financial ecosystem. Maybe you could just build a little bit more on top of you. So you've given us kind of a baseline of what crypto is, DeFi is attempting to build and hoping to build and obviously get enough adoptability to get there. Now, maybe talk a little bit more about the stablecoin economy and what that means.
One of the most successful applications that have been built on crypto settlement layers are stablecoins. What we found is what the industry has seen is there's a tremendous amount of demand for dollars. And when you remove a lot of the frictions for moving and settling in dollars, it just explodes. And I think this is most palpable first in emerging markets that have very low connectivity, let's say, to the dollar financial system, even though they have very high demand. And whether it's a producer in a resource-rich country that wants to buy and sell commodities in dollars, for example, and avoid the hassle of having to trust 50 intermediaries and so forth, stablecoins just offer a much, much easier settlement experience to just simply an Argentinian saver who doesn't want to hold their, savings in a rapidly depreciating currency and would prefer to hold a slightly less rapidly depreciating currency in the dollar. And stablecoins open that access to them. So prosaically, when we say the world is becoming stablecoinized, we think that this is such a superior form of settlement and payment that we view the world eventually moving to a very large share of financial transactions being conducted in stablecoins. There will likely be a long period of coexistence, but for a digitally native audience, I feel like stablecoins are a much more natural fit. And you know, I have a 11-month-old daughter who may never open a bank account if I can avoid it. Whose experience with savings may well just be Steakhouse products forever, and will never touch a bank unless it's a bank that offers some kind of stablecoin functionality. And so what Steakhouse does is uh, we are using DeFi building blocks to build asset management like products for stablecoins, and essentially building a credit layer on top of stablecoins.
So before we get into more of kind of your product set and a little bit of what you guys do, my next question is kind of I guess a two-part question. One is, and this is the thing I've always struggled with and granted my sophistication of this space is limited. It's been more of a interest, but from afar, is twofold. One is how do we take individuals who are not native to products like these and get them to move to products like these and away from the traditional financial products they're used to using. And then the
Yep.
second part is how do you decouple the intermediary like system that has built traditional finance,
Mm.
because there'll certainly be a tremendous pushback from them because you're removing their fees and everything that they've built these big businesses on. Like how do you accomplish those two things with DeFi, with crypto, with this new stablecoin system? And I think just the last comment before you answer, my critique of this space has always been I felt like those that are creating some of these products have always talked in time horizons that are way too short. Like, oh, we're going to transform, and fintech had this issue too. We're going to transform the banking
Mm.
system in 5 years. Like nothing is transformed in 5 years.
Yeah.
So just that, that's like a last comment to that. But curious your thoughts on kind of moving people to the products and then kind of decoupling that intermediary layer.
Yeah, I think on the time horizon point, I think I would probably agree. Like we view this as a generational shift, right? So, there's people who use like banks are always going to stick around. They perform a valuable service, they offer valuable products. Most people never even think about who their bank is, why. And
Yeah.
honestly, that's probably fine. That's actually the service that those banks need to deliver for these people. It's more, I feel like the adoption will come as in sort of two ways. One is a sort of leapfrog way from consumers who have no existing or limited existing access to traditional banking or bank deposit products in different currencies. And there is a precedent with M-Pesa, for example, with mobile money in East Africa, where
That's a good point.
mobile telecom operators have essentially become banks, or you know PSPs or something like that.
Yeah.
And some of the more interesting experiments that we're following in stablecoins are the conversion from stablecoins to mobile minutes, and the transferability of mobile minutes as a new currency in its own right, as a sort of in-kind or commodity currency that people exchange. Instead of exchanging a dollar, they'll exchange 50 minutes or whatever for goods and services.
Interesting.
So that's a sort of leapfrog perspective. The other is either existing institutions start to build in functionality to connect to stablecoins. If the demographic of stablecoin users continues to grow, this will become a much more important user segment to serve, and hopefully we'll see more traditional bank deposit institutions, for example, accepting stablecoins at face value and recognizing them at par and so forth. On the point about the intermediaries, on the point about par, actually, one of the biggest, more even than the intermediaries, one of the biggest frictions at the moment that a lot of academics and central bankers tend to focus on is the lack of singleness of money in stablecoins. So just from when a JP Morgan dollar transfers to a Citi dollar, the user doesn't have to know or care what bank it came from, who, where, what. They just see dollars. And so there's complete fungibility with the dollar. And to a degree, this is enabled by regulation. There's such a deep integration of the public sector into the monetary system in every developed country at the moment
Hmm.
that you can't avoid having some kind of regulatory framework to capture this. And I think Genius goes a few good steps in that direction in the US. In Europe, with Mika, for example, they have an interesting there are a lot of problems with Mika, but one of the more interesting things that the regulation does is say that if you are a stablecoin issuer and you meet these requirements, you are a euro. And so whether you're a stablecoin euro or a bank deposit euro, it's a euro, full stop. And I think this, you know, removing these barriers to singleness is very important to actually make this ecosystem fluid. Absent that, you basically have to depend on the secondary market. And this is what a lot of people index on. You have a market for stablecoins like USDT is trading at 99.998 cents versus USDC, and therefore, the whole system is broken and will never work. It's funny because again, if you look back to history, you find periods where private banking systems have emerged somewhat spontaneously. One good example is in Scotland in the 17th century, where unlike in England, there was no sort of government-run Bank of Scotland that emerged to coordinate the emergence of a Scottish banking system. You instead had individual companies issuing their own private scrip, and you had a similar parallel to the history of stablecoins, where you had the different flavors of Scottish pound compete against each other, try to do bank runs against each other, be really aggressive. You had the value of a Scottish pound be more or less depending on where you were geographically, because if you were far away from the branch, it would, cost more. And eventually they all came together and settled and realized that actually this is really stupid and the whole economy would grow much faster if we just recognized each other's liabilities at par, which is what happened. And I think it's a good illustrative example of how we view a positive evolution of singleness of money and stablecoins, which you absolutely need for stablecoins to actually take hold of like meaningful transactions in the world economy for sure. And the other part about intermediaries, I'm more positive about it. I mean, I agree that certainly there's a lot of incumbent players that are looking at the space with a lot of suspicion, particularly bank deposit institutions. And they occasionally have allies in central banks who, for them, I suppose the worry is if there's a big outflow of bank deposits into stablecoins, there will be a huge contraction of credit, and then the economy will grind to a halt, and people will, I don't know, be trading meme coins all day instead of investing in SMB loans. We're much more positive about it. I still think that even in a stablecoinized world, there's a role for bank deposit institutions as custodians and as loan originators. And I think what we're showing is with our product is that you can actually create a credit layer on stablecoins. And what that market structure looks like today is through regulation, mostly in the US and Europe, stablecoins are basically narrow banks. They are forbidden by law from investing fractional reserve. And instead, all of the credit activity takes place in other intermediaries. I do think that, Tether is a good example of well, firstly, it's the most successful stablecoin. And secondly, it is a fractional reserve stablecoin. And it's basically fine. There has been a lot of like noise about Tether in the past, about its solvency and so forth. Now, with Tether so plugged into the US financial system, with custodians in the US, with Cantor looking after the reserves and so forth, I think there's no doubt now about the quality of those reserves. The liquidity under real stress is still open, and every fractional reserve bank has to contend with this. Mm-hmm. So I do think that theoretically it might be possible, but in practice, in the world we exist today with the regulations that we have, what we will see is mini narrow banks issuing their own stablecoins and a credit layer built on top of people borrowing and lending in those stablecoins.
Why is 2026 the year that credit moves on chain?
I think so. We've seen a lot of growth in 2025. I think it's good from an institutional perspective because it validates that there's a pool of crypto native demand of people who have and operate in stablecoins and who have an aversion to moving into bank deposits for whatever reason. Steakhouse Financial is an example of this. We are a completely crypto native company. We, pay our invoices, suppliers, contractors entirely in stablecoins. So this credit activity and this stablecoin activity is already happening. In most of the credit activity is still very much asset-backed finance, more like Lombard loans than like small and medium business loans, for example. So it's more, a holder of an asset that they perceive to be store of value, like Bitcoin. Instead of having it just sit there in their wallet, they want to access some liquidity against it, and DeFi repo markets offer the best menu for that liquidity. And so you've seen a tremendous amount of growth. I mean, Steakhouse, just in the year 2025, we've gone from a non-custodial balance sheet of repo markets in the hundreds of millions to over 2 billion today. Still very small in sort of traditional banking terms, but very much sort of proving that there is actually demand for lending stablecoins for for safety seekers, and borrowing stablecoins for risk seekers, which are the two ingredients that you need for a functional credit repo market. And Coinbase, I think, and so this has been very effective at attracting institutional interest, and we've started to see the first innings of real fintech integrations that build these experiences into their apps and into their products. Coinbase being a salient example. So Steakhouse has an exclusive partnership with Coinbase where we operate vaults on their behalf. These vaults are run non-custodially, so the user remains fully in control. And the user experience from their perspective is, if they hold stablecoins on Coinbase, they can lend them in DeFi and withdraw them in DeFi and earn an interest and so forth. Similarly, Coinbase offers borrow functionality, so Bitcoin holders are able to borrow stablecoins from that same venue. And it's very easy to map, like, you have asset-backed financing, what traditionally might have been a loan against gold, for example, in somebody's portfolio, to moving into receivables financing or CLOs or more traditional types of instruments that actually permeate into the rest of the economy. So I do think that 2026 and beyond will see increasing institutional interest for sure. Of all the asset managers and banks that we're speaking to who are looking at the space, looking to get educated, I feel like their first intuition is, okay, we have these funds, there are crypto native investors. Can we grow our AUM by tokenizing the funds and just putting them on chain and hoping that crypto native investors use them? That's fine. I feel like that has much less runway than actually thinking, are there any small and medium businesses in our CLO that would prefer to receive their loan drawdowns in stablecoins? And therefore, can we actually stablecoinize the entire payment chain more organically from
you
bottom
got to
up?
get people using it. All right.
Yeah.
I mean, that ultimately it's like you can get someone to do an investment or maybe do like a test case. But I mean, you want people on the product, using the product, receiving stuff, sending stuff. I mean, that's the only way it really gains adoption, is that constant use of it. I mean, people got used to
Yep.
using credit cards because they used them. People got used to
Yep.
doing whatever the financial activity is because they ultimately do it.
Yep.
And I think the way in which it continues to grow is just more and more people move things, even if it's small, because if they do one thing on it and see that it's more efficient, more transparent, easier to track, easier to say, hey, I know exactly what I have or what I don't have,
Mm.
than a lot of products today where there's still that level of I don't know this or I'm not sure about this. It feels like there's always been this element of financial products where there's like you feel in the dark at some point through
Yeah.
that financial
No.
product. And I think crypto DeFi
Yeah.
world, part of that is solving for that because it's always giving the user the power and the control, right?
Yes. No, I agree completely. And the user in this instance can be somebody using a Visa card that's loaded with stablecoins as collateral, so they don't have to worry. Visa sort of takes care of the flow of credit down to the merchant and the acquirer and so forth, all the way to Stripe more as an intermediary business who may look at stablecoins as a way of facilitating cross-border transfers within their own companies instead of waiting. You see this in large international companies. The treasury management function is key for working capital, and they always have to contend with all these different FXs, currencies, bank exposures, credit risk, days in transit, SWIFT, and so forth. And stablecoins functionally solve that by compressing it down within a day. I mean, yeah, again, in my experience, like whenever I send my rent payment, which I still do in bank deposit currency, I kind of wonder in the back of my head, like, okay, is this going to make it? Like, when is this going to arrive? With stablecoin transfers, I have a cryptographic transaction hash that I can follow, and I can see where it's gone immediately.
Or it's like,
my expectations.
the most natural thing is like you have these pending transactions, or when will it post, and like, the money in your bank account is available money. You started with like $2,000. Available money is 1,500. You have all these pendings and like all these other like Visa processing, like it's $0, and it's like, oh, it's processing something, but you're always unsure. It's like, all right, so exactly how much do I have? But the
Yeah,
stable coin is, all right, it's settled and it's
yeah,
fairly quickly. I mean, a day is a lot quicker than most of the other things. And you said they're working on doing it in microseconds. So you have finality of whatever the transaction is in near real time.
yeah, essentially. And I think that's really like the wire world and the Swift world. Swift is a very important, like very overlooked piece of financial infrastructure that functionally connects sort of mini protectionist, like the way I think about like Fedwire and SIPA in Europe and BCAS in the UK and stuff is sort of like mini protectionist fiefdoms to shelter incumbent institutions from foreign banks coming in and competing on payments, for example.
Mm-hmm.
This may not be the explicit goal, this is functionally what they've become. And,
Yeah.
Swift is kind of the attempt to duct tape all of these systems together and make them speak to each other. And stablecoins, again, kind of ignore all of the priors, sort of wipe the slate clean. And let's just forget all of that and just do it on this settlement layer instead. And you have a lot of interesting possibilities that emerge even in the FX market. The Swiss National Bank, for one, is one of the more, let's say, forward-thinking central banks out there with respect to DeFi, with respect to crypto. This is generally a very Swiss perspective. They're very pragmatic. They look at the benefit of a technology and they evaluate it on its own merits. And they run experiments on, can central banks settle FX between each other using DeFi protocols like exchanges? So can we have a tokenized wholesale Swiss franc trading against a tokenized wholesale Singapore dollar and have the market sort of settle what the rate is and then just use that to net immediately instead of having to wait a week? And I think these are really core pieces of sort of financial plumbing that often get overlooked when people talk about crypto and DeFi. Like, this is the sort of thing that animates us at Steakhouse. Like, we're obsessed with this, and we're quite sure that the benefits will eventually materialize through simply businesses accepting it. Or even in the case of a merchant with a payment terminal who may have to wait for a week or more for the funds to actually hit their account with a stablecoin back.
Those are the applications I think show, that real tangible immediate value of a business, that I know this money is here and I know
Yeah,
it's settled. I don't have to worry
yeah,
about whether or not it could be reversed on a charge, or like, hey, it's happened, it's settled, boom. And now I know I can pay my employees, or do I have to take out working capital because there's so much that is unsettled.
yeah,
And then it, probably drives a lot of anxiety and fear into business owners, because there's so much of the system of the plumbing that is in this kind of state of unsure.
mm,
And crypto and these products help to at least give it immutability and finality to it, which gives a lot of power back to the business to know, hey, I don't need working
mm.
capital. This is actually settled. I can pay here, and then maybe I do need it during a certain period of time, but I don't always feel like I need that.
Yeah. No, I agree. And with this change in leverage, there's a lot of in the sort of card payment space. There's a lot of research into some features like, for example, chargebacks or fraud protection, which are sort of quote unquote anti-business to a degree. So a business is always sort of worrying, like, am I going to get slammed with a chargeback that I have to fight for a month before I see
Yeah.
the money? It is also a feature, the fraud prevention, for example. These are unsolved. These are smaller sort of tactical examples of things that I think the stablecoin space has to solve in order to really gain acceptance. The finality is obviously amazing for the business, but if it's a fraudulent transaction, then if the credit card industry has to send the enforcer out to the merchant and get the money back, and it's a bit more complicated than simply reversing a card transaction. And so yeah, there's obviously a lot of kinks to be ironed out, but we're quite confident that they will eventually be ironed out. And for practical purposes, many people are already using stablecoins for commerce and for payments. And the next sort of step is obviously credit and repo markets.
There's since Bitcoin has kind of exploded on the scene, 2008-ish. There's been kind of these ebbs and flows. Hey, crypto's here, and then boom, and then it goes back up. And then, have you seen an impact on kind of some of these previous boom and bust cycles? A wariness about adoption or some of the product set? Is there an institutional worry given some of the previous boom and bust? I know some of this is natural. If you're building things, some things are going to blow up and you need to then rebuild in a slightly more controlled and maybe consistent environment. And so that always happens when you're trying to innovate. But has there been a
Hmm.
big impact on kind of adoption, or at least do you get lots of questions related to maybe some of the previous cycles?
The the boom and bust. I feel like the boom and bust cycles are getting less volatile, to be honest. Like you feel them more acutely when the base is small and the bubble is comparatively quite big, and then the bust is obviously also huge and demoralizing. The last major turn that I think was probably systematic or systemic to the DeFi industry was the collapse of the centralized exchanges like FTX or the Ponzi scheme Terra Luna. The example, like kind of cringe and embarrassing examples to have to refer to that people always bring up. So again, sort of in the tradition of reinventing financial history, like we reinvented the tulips, we had that moment. We reinvented the Bernie Madoff. We've kind of gone through those, and we're slowly catching up to the present day. Uh, Within DeFi, you also have many. What is less sort of noticed is within DeFi, you also have many booms and busts, depending on investor sentiment, which are also interesting. And yeah, I think they definitely color the perception of it for institutional adoption. But as these booms and busts get less volatile over time, I think it becomes more clear that this is a secular trend, and the interest is more uh, anchored in sort of, okay, we know that there are regulated hedge funds using this. We know that there are banks touching this. We know that there are, credible players that are transacting in these stablecoins. So how can we get involved? And and lately, that's been most of the conversations actually around, in particular, seeing large players like Coinbase like really not just be an exchange, but really start to push into financial services for consumers and actually start to compete with bank deposits on that basis.
What about and part of this might have been in your answer in terms of the younger people being born in the last few years and being essentially digitally native to start with. But there is an element of people out there that money works.
Mm.
And practically speaking, they know they get paid, they know they can use a card, and it works from their point of view. And it's like, why upset that? As
Yeah,
long as I know that my paycheck goes in and I can use that paycheck. If I need to borrow something, I know that process. Why change any of that? And this might just be generationally the difference. Like there's a older generation that is, hey, money works and that's the way it's gonna work. And then there's digitally native of, hey, everything should be programmable, everything should be digital, and I shouldn't have to worry about the way money used to work. What about that dynamic?
I it'll definitely, there's definitely going to be coexistence for a very long time and cross-pollination of one into the other. And you're right, for most people, especially in the developed world, money basically works to a degree, largely until it doesn't, where I think you'll start to see more innovation creep in is around spread compression and efficiency, in particular in credit or in things like credit servicing that is still very manual, very technical, requires a lot of legal work in the back end to make work. The benefit of having a tokenized equivalent or a spreadsheet running on chain is just the speed of being able to run some of these executions and some of these originations. And what that means is spread compression. And so that competition might be more difficult in developed markets where the spread is already inherently quite narrow. When you have a rate environment that's at 3, 4, whatever, and you're pricing loans at even 2 or 3% above SOFR, it's very difficult to, it'll take a bit longer for that spread compression effect to actually make a huge difference. It'll probably emerge in less efficient markets, whether they're developed or otherwise, or in instances where a consumer may find a way to refinance or gain access to credit in a slightly more cheaper way by doing it on chain. And so I think that DeFi's main competitive edge is around spread compression for traditional credit in that regard. That's for sort of the existing, let's say, set. The other aspect is more around the sort of innovation front. So one thing that people overlook, so it's very easy to sort of overlook crypto finality and the cryptographic guarantee. And if you step back and sort of think about it, and I'm going to try and sort of not get dragged into the jargon and the technical knickknacks, but fundamentally, when you build a financial primitive on crypto rails in DeFi, what it does better than an incumbent system is essentially sort of 3 or 4 things, mostly around sort of rule enforcement. So what DeFi offers relative to traditional finance is more effective and cheaper rule enforcement, less potential for abuse from central parties. It's easier to spin up new rule-based systems, and it's easy to switch between rule-based systems, which means there's more system-level competition. So you see a lot more competitiveness in DeFi than you do in traditional finance, which has a forcing effect of making the system far more efficient, much faster. And this rule switching concept is also the equivalent in traditional finance is if you sign a loan agreement, you sit with the lawyers, they draw the contract, you sign it, then you execute it, which may or may not go according to the rules. And if afterwards one of the 2 parties doesn't follow the rules, you have to go to the judge, and then the judge decides, and then the policeman with a gun comes and forces the thing to happen. And with crypto, that entire chain is compressed into the same transaction. So you select the rule environment that you prefer. It could be, for example, one repo market or another, the way that they calculate interest rates, the terms that they offer on different collateral. And once you use it, you're locked into it being enforced in exactly the way that it's been designed. So you can't really go to arbitration against the program.
There's less ability to manipulate.
Yeah.
Because it feels like in the current system, if you have the money and the power, you can push the levers you need to manipulate the system in your favor. In the DeFi crypto world, when the rules are set, that's the parameters. They can't be manipulated to your advantage after the fact.
And if you don't like the rules, you can make a new program with different rules and see if people sign up to that. And that system competition, I think, is a very important forcing function that has been difficult to see in traditional finance, in particular after the global financial crisis, where a lot of the competition has been sucked out of, the oxygen has been sort of sucked out of the market because everybody's terrified of the bank failing. And so the public sector has a very, very strong sort of bid on the entire, industry. And it's very difficult to opt out or do something a little bit different or shop around for a loan, for example. Whereas that in DeFi is sort of the base level. If you don't like the terms of one DeFi protocol, you can use another. and where the leverage is more around the adoption of a one particular program over another. Like a tangible example of this is like in the sort of boom and bust cycles in 2022, you had or 20 whatever in 21 in the 21 cycle, you had a large fintech, Celsius, that was essentially perpetrating a fraud on its users
Yeah, I
by
know.
taking their assets, and trading them. And some of the positions that they held were in DeFi smart contracts or programs. And in order to unwind the bankruptcy estate, the liquidators essentially had to repay the loans on DeFi, functionally making DeFi senior even to the bankruptcy estate. And this is kind of a live example of what I mean of rule enforcement and arbitration and execution in the same thing. Like there is actually nothing that they could have done other than repay the loans and recover the collateral if they wanted to have that collateral back.
I know we're coming up on time in a few minutes. Couple of last questions for you before we end with some fun ones. What about the different systems? Bitcoin, Solana, Ethereum. Like, does there have to be more building of interoperability between them and even like the traditional financial system, like more of an intermediary layer, so to speak, so they can better coexist? Because obviously it's not going to be like, oh, there's only one system, because people
Right.
are going to want to build other systems, and they're going to want to build ones that are more transparent and open, or maybe some that are a little bit less, but ultimately there's
Mm.
not going to be like only one winner. And so what about the kind of different systems and making sure there's more connectivity between them?
Yeah, the like from Steakhouse's perspective, we basically take the view that all these settlement layers, these crypto networks, are solving for different things, and they are very good examples of like the simplest possible rule set that a user could choose to subscribe to. Like in Bitcoin, people don't want programmability or any of the knickknacks; they just want something that sits and that nobody can change. With Ethereum, they want a high level of security and programmability. With Solana, they want speed. Uh, there is a high degree of interoperability between these venues already. Obviously, the more the better. Coming back to the singleness of money point, the closer we get to par redemption of assets and stablecoins and tokens between chains, between venues, and so forth, the much easier it will be to actually build a functioning, economy on this layer. We don't take a strong view as to which one is better, which one is worse. I
Yeah.
agree basically that more interoperability is better, and each of these rule systems is solving for something slightly different, and there is going to be users for all of them. And the one thing that we would look out for is generally the level of cryptographic security. So the one reason you would use crypto networks over traditional networks is you don't want to have to trust the central party to enforce rules. To the degree that using a crypto network forces you to do that, there's basically no point to doing that other than maybe some marginal efficiency around computation. So we do view public and open blockchains to be better, let's say, for creating this financial economy than closed ones or permissioned ones. But yeah, sorry, I could rant for hours about stablecoins, credit. Yeah, hopefully,
And
no, hopefully, my goal here is to provide the average FT crypto commenter with the perspective of somebody who's a pure finance nerd talking about stablecoins, not like they're alien creatures, but like they're just money, which from our point of view, they are. And with money comes credit. And that's what Steakhouse Financial is focusing on, actually building on crypto.
no, I think the way you've been describing it is very much digestible and easy to see the connectivity to from where we are today to a future that includes more of these products,
Mm.
even though some of the traditional financial system will coexist with them for a very long time.
For
And I
sure.
think
I
the
mean, yeah.
coexistence, I think some people like view it as it has to be one or the other, but in reality, it's
Mm.
never gonna be one or the other. There's always going to be some level of coexistence until, the 5-year-olds of today are, kind of dominating society because they can make that generational change, as you said, because there are digital natives and some of the older people obviously will no longer be around.
And I hesitate to bring in the topic of AI. I really don't want to make this buzzwordy, but to the degree that an AI is able to see money, it will most likely be something more like a stablecoin than a bank deposit, is my view.
I would agree.
Whether AI takes off or not, yes, the Matrix and the rope, that's all I'll say. That's all I'm going to say about it.
So we have a few minutes left. I always like to end a little bit lighter with some questions. So, do you have a favorite sports team and/or hobby?
Yes. So my favorite sports team is Real Madrid in football or soccer, like you might say. Sorry, I don't know what I find NFL and all these things just fascinating behavior. Don't understand it. My hobby is my newborn daughter, which takes up all of my free time. And she not that she has chosen, but she is also a Real Madrid fan by birth. Yeah.
Oh yeah, I can understand that, how you pass down your fandom for sure. One surprising thing about yourself.
I can make origami rabbits. It's not something that comes up very often. I can make them I can actually make them behind my back. Yeah.
Wow.
I make a lot of them.
Interesting. Yeah. One book that you'd recommend reading?
On the point of Scottish banking, A History by S.G. Checkland. It's a very nerdy, deep finance history book, out of print. Again, like a kind of a peculiar history of a banking ecosystem that, in our view, proves that free banking can work and that everything is going to be fine. It's out of print for now, but we're trying to bring it back. So, stay tuned to the Amazon bestseller list for when we bring it back and it cracks the rom-com novels and all this to lead it to top the charts.
Most exciting part of your job?
The blow-ups. We didn't talk about this, the mini cycles of booms and busts and the cost of credit on chain, but they happen a lot. And it's extremely nerve-wracking and it's wild and it happens in real time. And a month in crypto feels like a year. And that's definitely exciting. Yeah.
And then final question, one prediction for the next year.
My strongest prediction is that Greenland will continue to be covered in ice. And for all other macro views, I have very low quality opinions.
And on that note, Adrian, I really appreciate your time. I think it was a fascinating conversation. So thank you, and continued luck to you and the team at Steakhouse.
Yeah, thanks for having me. And if you get any angry FT crypto commenters, just send them my way. I'll be happy to chew their ear out for selling them stablecoins.
Will do. Thank you for listening to the Credit Clubhouse podcast. Credit Clubhouse is brought to you by Deal Catalyst, the leading capital markets events and market intelligence company. For more information on Deal Catalyst events, surveys, and a whole lot more, please head to www.dealcatalyst.io. Thanks for listening. Until next time.